warnings, I believe, are almost always shown in your financial statements or your management accounts, if you may say. So if you know how to identify this and how to read this, you can be more proactive instead of reactive, which is probably one of our biggest weaknesses as big business owners. So on the subject of what keeps you up at night, I want to run a quick mood test to understand what are the things that keep you up at night. You will see a pop-up shortly. We're running a poll. If you can just share with us and indicate what some of your biggest problems are in your business. I will give it a minute. Okay. So our poll should be live. Please do contribute, share, let us know so we can get an idea of if we're on the right track and if the subject matter is relevant. Oh, wow. Okay. So I'm going to close the poll. Thanks so much, guys. So I'm sharing with you the results so you can have a look. And I think our feeling has been right on track. I think some of the biggest problems involve market access as well as cash flow problems. And access to funding is always up there with the other two. Okay. So our first topic was the most obvious choice. Given the current economic conditions, we cannot ignore the fact that the pandemic and the economic crisis that comes with it has posed a challenge that we just never expected. So we definitely have our backs against the wall at the moment, and a cash flow crisis is even more challenging for small business owners. And we don't always have the shock absorbers that larger businesses might have. You might or might not be familiar with the term VUCA. VUCA is a trendy managerial acronym for short for volatile, uncertain, complex, and ambiguous. Perfect description of the current environment that we're in. So at the moment, we've been forced to respond to VUCA. I'm just sharing here a little illustration of what that looks like and some of the things that as business owners and leaders, what that means we should be doing to respond to that. So at this time, I think there's been a lot of talk about pivoting, and I'm sure you've been on webinar after webinar that talks about pivoting as fast as possible in response to the changes and constraints. And one of the things you also have to do is to change the way you manage your cash flow as well as how you've approached it if this was not something you really thought about before, because we do have to adjust your operations as well to respond to this. So how do we do this? You have to begin with the end in mind. I would like to think that as business owners, you have personal reasons for starting your businesses. You might be doing what you do because you want to be comfortable and have a business that can sustain your lifestyle. It's called a lifestyle business. Or maybe you have a family, or you're thinking forward about your family and you want to build a legacy for your family. It could also be that you want to build a sellable business, or you want to franchise, or if you're thinking big, you want to list on the stock exchange. So on that note, I'm just going to run another poll so we can get an idea again of why is it that you wake up every day to do what you do? Okay, you should be able to see the poll now. Okay, so we've got a fair amount of contribution. I'll give it a few seconds and take in the results. It's quite an interesting outcome. Okay, so I'll share the results with all of you now. So, like I said, we all do it for a reason. And at the end of the day, as much as we exist to solve a problem, we still want to take care of ourselves. And it's very normal for most of us to be doing this, to build a legacy for our businesses, whether it's for your children, your wife, your husband, your grandchildren, or your extended family. And the long-term goal is you want to build transferable value. Like all goals, you always think about what your long-term goal is, and this big goal will be broken down into smaller, bite-sized, short-term goals to get where you want to be. You might have thought about what that number looks like, and this is informed by what you dream of doing in the future. So for example, I want to buy a wine farm in Cape Town. You know, sometimes you have to set those big goals. So for you to start thinking about how you achieve those goals, this should form the basis of forecasting what your business should be doing for you. So here's an example what that might look like. Okay. So this is Chiedze's dream. I want to buy a wine farm in Cape Town and hopefully retire there and drink wine from dawn to dusk. So let's say that to live this lifestyle, I need 3 million Rand per annum. And I want to retire in 15 years' time. And let's say, for example, I put aside about 100,000 a month. So that is the dividends that I take out of the company, and I put them in safe investment. And I want an interest rate of about 5% a year. So the transferable value I'm trying to build is 75 million. And I need to set aside over 3 million a year to achieve this dream. For me to do this, my business needs to give me a net profit after tax of at least that amount. So this might not happen now. This might be my informing figure for me to start planning what my revenue should be so that I know just what kind of business I'm trying to build. At the end of this webinar, we are going to send you a similar goal setting questionnaire, and you can fill this in and we'll send you the calculation of what that will look like for you and your dream. So onto the reason that we're here. All right. So what is cash flow? So cash flow is the lifeblood of every business, and running out of it is the number one reason that small businesses fail. Even if you're making plenty of sales, if you don't have enough cash in the bank, your business won't be able to pay its bills and stay open. Cash flow is the difference between the amount of cash a company receives and pay, so that's the inflows, versus the amount of cash that you pay out. So that's an outflow, and it's usually measured over a specific period of time, be it a month, a quarter, or a year. So in simple terms, this is the cash flow formula. All right, sounds simple enough in theory, but in real life, it doesn't always happen this way. you're juggling so many things within your business, so many unforeseen things, circumstances, things beyond your control. So as much as this is a very simple formula, sometimes it's really difficult to keep on top of it. So your business will bring in money through sales, returns on investments, and from loans. So that's cash flowing into the business. Then you're going to spend money on supplies and services, utilities, taxes, rent, loan payments, and other bills. So that's cash flowing out of your business. So if your cash flow number is positive, your business has got a positive cash flow trend and accumulating money in the bank. So this would hopefully not sitting in your check account. You've got an investment account where you're putting this money into. If your net cash flow number is negative, your business is cash flow negative, and you're finishing the month with less cash than you started with. So believe it or not, it's possible for your business to be profitable, but still run out of cash. So I've often had clients in the past who have asked me why they don't have money when I'm telling them they've made a profit and they have a huge tax bill. So of course, at this time, the money is long spent. So here's the reason why. Profitability is the difference between revenues and expenses. So here's an example. So let's say you have 100 Rand in a month. And from that, you have to pay your supplier 50 Rand for purchases, and you have office overheads like rent, salary, and stationery of 30 Rand. These are obviously theoretical figures. So in reality, these are much bigger numbers, but I have made it small so it's digestible and understandable. So your profit for the month will be 20 Rand. So Tjeerdsal will give you a profit and loss statement of 20, which shows you you've made a profit of 20 Rand, and that's what you need to pay tax on. All good and well. But the reality is, outside of that, there are the forces that happen within the business. So let's say, for example, your payment terms are 30 days from date of sale, and only 50% of your customers pay on time. So you only receive 50 Rand. Okay, so now you have a problem, right? Then let's say your supplier does not accept any payment terms. If you want the service, you're going to have to pay for your goods upfront. Now you need another 50 Rand in order for you to get your goods so you can deliver to your customers. You need to run your office, you need to run your business, be it working from home, be it an office. You will have some expenses that are directly linked to your business, all right? So you still need to pay that 30 Rand a month. So this is where you might find yourself in trouble, because it means that after paying your suppliers, you do not have enough cash for office overheads or to repay your loan. If you had anticipated this, you would have seen it coming. You will then have to dig deep into your own pocket or borrow money to meet your monthly obligations. Sound familiar? I'm sure many of you know this situation. I know I do. So what are some of the symptoms of cash flow problems? All right. So quite simply, if you have a positive trend in cash flow, it's easier to pay your bills, including salaries and taxes, to invest in new opportunities, or to reinvest back into the business to grow your business so that you can expand your reach. And it's also, if you have positive trend in cash flow, it's so you can stomach unpredictable factors within the environment. But when you have a negative trend in cash flow, and the emphasis on negative trending, all right, so trending meaning that it is happening over a long period of time. While you might have money in the bank right now, it doesn't mean that your business will eventually run out of, it does mean that you will eventually run out of money if you don't become cash flow positive at some point. So 1 month of negative cash flow won't necessarily tank your business, but when you start to see a trend and you don't do anything to reverse it, or when you're pleasantly surprised because you have been tracking your cash flow, that's when your business is at risk. A hidden reason for cash flow problems for most business owners is that you could be overextending your business and overinvesting in capital, operating expenses. And when you do that, you leave a very small pool of cash flow, meaning that you are less flexible in the short term, and you might not be able to recover from that. So there are various reasons, there are various symptoms that could indicate what are potential cash flow problems. I specifically want to speak about these because these are the most common that we've seen amongst, a specific set of clients, specific industries, mostly in services. And this is what we deal with most often. So when your accounts receivables are increasing, so meaning that you have more money, more people owing you more money at the end of every month. And this does not necessarily convert to cash in the bank. So it's normal business practice to deliver a service or product and only get paid after delivering. So these are called accounts receivables or debtors receivables, depending on whether you're American or from the rest of the world. It's also normal to have some unpaid invoices. However, if you find that month on month, your accounts receivables are increasing in value, but you're not bringing in more cash, this is a red flag. So an important KPI you should be monitoring is your accounts receivable aging. You should know your average customer days. So in plain English, this is how many days it takes you to collect from your customers. Usually it's not more than 30 days, but the trend in South Africa is to aim for about 7 days. For every day your customer doesn't pay, you are giving them a loan. And most often, the longer they don't pay, the more unlikely it is that they will pay you. So you should be aiming to decrease the lead time between the invoice and the payment, as in reality, like I've mentioned, it takes longer for you to collect. Also, if your sales are declining. So your sales declining could be for several reasons. It could be because of the most immediate thing I can think of is macroeconomic factors, such as the current climate that we're in. It could also be that there's an increased competition in the market. Maybe you've priced yourself too high. Maybe there's a particular demographic you're selling to that's not buying as much anymore. Or it could be, we don't like to admit it sometimes, but maybe there's a problem with the quality of product or service that you're selling. Again, if this is 1 month or 2 months, this is not something to be extremely concerned about. But if you start noticing a trend, then it's time to go down to the root cause and figure out what's really happening in your business. So the third indicator is if your business is not profitable. So this is the most obvious symptom of pending cash flow problems. So while you might have money in the bank right now, if your business is spending more money than it's taking in, it follows to reason that you'll run into cash flow problems at some point. And seeking funding, as much as it might be a temporary solution, it is a band-aid to the problem if you haven't figured out the problem for your losses. A high dependency on loans could have you ending up hiding a problem which you're not fixing right now, and in the long run becomes more difficult to fix. So you end up saddled with a business that's running at a loss and carrying a heavy debt in your balance sheet. Losses might also be because your business has not yet reached critical mass. So it's not all doom and gloom. And we talk about critical mass, we're talking about, we call it break even as well. This is getting the right amount of customers in order for you to be able to at least make a zero profit. So the key is being able to understand and interrogate your accounting records. So some of you might have already Some of you might have already read our article that we published earlier this month on how to improve cash flow within your business. So I'll obviously be very brief in this section because we don't have all day. And this is something that I've gone into in detail. And like you, I'm an entrepreneur before I'm an accountant. So I also have challenges of trying to keep the businesses afloat because we're also battling with a lot of forces that are beyond our control. There are endless ways to approach this, and we'll need a few more sessions to unpack this, but I'd like to personally share some of our experiences and our tools and methods and the things that we've thought about in managing our cash flow. So being in the services industry, the biggest thing that you do, you're selling time, right? It's your expertise and your time equates to the fee that you charge your customers. So it doesn't matter what you do. You could be in HR, you could even be a hairdresser, because hairdressers are selling time as well, and skills. So everything is time-based in this particular space, including manufacturing. You know, it's also got a time element to it, as well as hard inputs that you put into the product. So at the core of the business is the cost it takes to deliver your services or manufacture your product. And it's important to understand your labor cost, or your fully loaded burden rate, which factors in things that people don't normally think of. We call them fringe costs of employment. So the true cost of a person is not just their salary. It's the company tax contribution, it's insurance, it's workman's compensation, it's their uniforms, it's their training and development, it's the office space they take up per square meter in your office, it's the tea and coffee they drink. I could go on and on. It's the Wi-Fi they use. So there's a lot of things that go into this. And so we call this the fully loaded burden rate. And it's one of the biggest things that small businesses overlook. And because of that, their pricing is incorrect and they make losses, or they don't achieve their margins that they think they should be achieving. So what you should be doing is tracking your time spent based on the market rate of your labor resource. This allows you to see who is causing you cash flow problems and contributing to profitability. So where you identify low margin customers, you obviously have to have a very difficult conversation with them, and you need to renegotiate and also try to manage the scope creep, because that happens a lot in services. I know I'm talking to a lot of services people right now. The same thing does happen for products as well. So for example, there could be material wastage, there could be time wastage by the people in your plant. So the principles are still the same, be it services or manufacturing. And sometimes when it comes back down to it, if you figured out where your low margin customers are and they're not willing to pay the price, it might be time to cut those customers off. And a knee-jerk reaction in such a time is for people to want to give discounts or decrease their prices, but they're not really intimate with their figures and their costings. So it's not always the best idea. Okay, so the second thing would be to optimize your operation. So one of the things that happens when you start to really scrutinize your job costing, you start to identify your inefficiencies, and you can improve those. You can monitor your gross profit more closely. So for example, you might think that when you charge out a client, you might think your gross profit is 25%, but it turns out when you start doing your job costing, your margin is much lower than you thought it was. So you start to really look at things differently and change things around and move people around, move resources around, talk to your suppliers, whether it's a service or a product they're delivering to you, and renegotiate those products. So there's a lot of things you can think of depending on what goes into you delivering your service or your product. And you need to go through this process over and over again and repeat it until you create a flow and to begin to free up more time and resources and improve overall productivity and minimize costs. So essentially that top line is what you should be looking at. So that's your sales less cost of sales. And small businesses tend to disregard this, but this has a direct influence on your finances and can be the difference between a thriving business or one that is struggling to make ends meet. I would even say it's the most effective way, for at least for us. That has been our strong point. The third item you can do is optimize your cash flow cycle. I mean, there's so many ways of going about this. There are, again, like I said, there are so many things you can look at that are specific to your business. I'm sure everyone can attest to this. One of the biggest problems a lot of people have is that their customers never pay on time. So what you want to be doing when you're in a pinch is you want to tighten your cash flow cycle while also increasing the amount of customers that are paying you on time by lengthening the time, and also lengthen the time that you pay your bills, but without compromising your relationship with your service provider or your supplier. So this is called slowing the burn rate. A burn rate is the speed at which cash is reduced, and your cash runway is the amount of time you can operate before you run out of money, all right? So that can be 2 months, it can be 2 years. So basically, this is something that your forecast will be able to tell you. And having a healthy cash flow is having a balance between the cash going out, the cash coming in, and finding a sweet spot for that. So some things you can do is you can monitor your accounts receivable. So make sure that your customers are paying earlier. And one of the smartest ways to do that is to automate your invoicing and collections. All right. So when you automate your invoice and collections, you can use accounting systems that are able to automatically generate your invoices. They're able to send reminders to your clients or your customers. Offer early settlement discounts. These are usually very small discounts of about 2.5%. And also use payment platforms so that it's easier for clients to pay. I'm sure a lot of people have had a situation where a client owes you money and they need to pay you, and they have every reason why they cannot pay you, whether it's the internet is broken, or, I'm stuck in Swaziland because of the lockdown, and there's no internet there, or I can't get to a bank. I'm sure we've all had all sorts of excuses. So what you can do is link your invoicing platform to like a Paygate, where a person puts in their card details, and then it's easy for someone to pay, and the book of excuses gets a little smaller for them. And your stress levels are also lowered, and you're not always stressed because you're not sure if you're going to get your payments. That way you spend more time being strategic. Another big thing that I think a lot of people might have looked at during this time was to audit your discretionary expenses, right? So discretionary expenses are expenses that a business can get by without, if necessary. One thing that I like to talk about when it comes to that is marketing, right? Our poll told us one of the biggest problems that people have is access to markets, but most businesses cut their marketing budget. I'm not by no ways a marketer, but I think as an accountant, the one thing that you should be seeing is a marketing budget, and that marketing budget should be showing you a yield in terms of increased sales. So sometimes people consider marketing a discretionary expense, but it could be the reason that your business starts to fail as you cut that budget, and maybe you actually had a great marketing department. All right. Other discretionary expenses might be, those small bills that when things are good, your company puts money into them because, it's feel-good expenses to promote goodwill. So maybe you send your clients gifts every so often. Maybe you are very generous with your staff welfare budget and stuff like that. So those are the kind of things that you can be looking at to start to cut out the things that you don't really need in your business. If you are in retail, one thing that you can also do is purchase less inventory so that your cash is not tied up, which affects your liquidity. It's always so much more difficult to let go of inventory than it is to actually get that inventory. Just make sure that you have a reliable inventory supplier for when you need it, and purchase the bare minimum based on what your management accounts are telling you about your inventory turnover rates. So how do you forecast your cash flow? So a cash flow projection is all about predicting your money needs in advance. So unfortunately though, forecasting your cash flow is a bit more complicating than forecasting other aspects of your business, such as sales and expenses. So your cash flow statement takes inputs from revenue projections, your expense projections, and also your inventory purchase plans, if that applies to you. And in addition to that, you need to predict when your customers will pay you. Will all of them pay on time, or will some take longer to pay? So I'm going to discuss the easiest way to do this, which is called the direct method. It's straightforward. This is the method that you use when you, if you're using an Excel spreadsheet, for example, and it's more practical than using ratios and percentages, like, for example, that some tools we use as accountants. So essentially, you want to create future estimates of when you receive money from customers and when you'll pay your bills. It's not critical to forecast every single individual invoice and bill. So forecasting is about helping you make strategic decisions about your business, so you make broader estimates in the forecast. This method is also simpler to use when you're using spreadsheets. It relies on the simple formula we discussed before, which is cash flow equals cash received less cash spent. So the first thing you would do is we'll look at forecasting your cash received. So in your cash flow forecast, this is cash from operations section. I'm also happy to share templates with anyone who wants these templates to construct their own forecasts. Just drop us an email and I'll give you a template that you can use, which is user-friendly. So in your cash flow forecast, this is the cash from operations section. When you sell your products and services, some will pay immediately, and that's cash sales. You get that money right away, and that's what you put in your bank. And then some customers are on credit, and let's say maybe you have a 30-day policies. So if you make a sale in June, you're only going to receive the money in July. So you would not put that that receivable in the current month. That would now be sitting in your July period. So when you start to think about this, your management accounts or your knowledge of the business is how you really forecast what that might be. I always suggest creating, like, understanding what the percentage is. So if you know that about 20% of your customers pay you on time from your credit sales, then 80% of that will go into the cash column, and the other 20% will go into credit sales for next month. The second thing you have to think about is new loans and investments in your business. So you can also receive cash by getting a new loan from the bank or an investment from an investor. You would track this in the section for loans and investment, and it's worth keeping the two different types of flows separate, mostly because loans need to be repaid while investments not necessarily need to be repaid, and the loans have got interest consideration. So sometimes it's also good to see what the trends look like around that. The third source of income could be sale of assets. So if you're a company that uses a lot of assets, so maybe you've got trucks, you're in logistics, maybe you've got car rentals, So when you sell any of your assets, then that cash that you get from that would have its own line item. This is usually a good planning tool if you're asset heavy and you need to see what those cash flows look like, because it's most likely that you're also going to want to purchase vehicles in the same breath. The last section will be other income and VAT. So businesses can bring in money from other sources besides sales. So for example, your business may have interest income from the money it has in a savings account. Many businesses also collect taxes from their customers, the most common being VAT. And there are also other tax mechanisms that come into play depending on how complex your business is. So ideally, businesses will record the collection of this money, not in sales, but in the cash flow forecast in a specific row. You don't want to record your VAT, for example, in the same box as your sales, because you start to lose sight of what VAT you should be paying out if you do need to pay out, or if you are going to be receiving any refunds, and that's how you end up not paying them because you never anticipated it. Then the next section of your cash flow will be forecasting your cash spent. So this is similar to how you forecast the cash that you plan on receiving. You also have the relevant categories so that you can think about it logically. So the first section will be cash spending and paying your bills or invoices. So you want to forecast two types of cash, right? Spending related to your business operations. Cash spending is money that you use like petty cash, for example, or if you've got any COD, cash on delivery sort of expenses. But there's also the bills, which we call accounts payable or suppliers payable. These are the bills that you pay later. So in the same breath, you might have credit terms, your suppliers might have credit terms, and you only need to pay 30 days later. So you've got 30 days to take that service or product in order for it to generate it into cash. So you track those in accounts payable, and again, just like accounts receivable, it won't fall in the month in which you get the bill. You'll pay out the cash in the following month. And when you're focusing this row, think about the bills you'll pay and when you'll pay them. In the section, you want to include things like loan payments, assets purchases. Those have got their own section. Loan payments is very straightforward and understandable. So when you forecast loan repayments, you'll forecast these with the principal as well as the interest. All right. So the interest on the loan is also tracked in non-operating expense. Sorry, not in the principal payments. And then the next one will be purchasing assets. We spoke about the sales of assets. So these could be, like I say, trucks, equipment, buildings, or other things that you potentially need in the business in order to generate revenue in the long run. Inventory is also an asset that you might purchase in the business, to put it in simple terms. So this would also sit in this section. The last section is other non-operating expenses on VAT. Non-operating expenses would be things like your interest and whatever applies to your business. But it doesn't form the core of how you deliver your product. And then VAT, again, VAT must always have its own line item, because the consequences of not sticking to your VAT deadlines is that you end up paying much more in penalties and interest than you really need to. So I'm sharing a couple of tools and resources that you can use in order to construct your own cash flow. I've obviously kept it simple. Again, like I said, I am trying to make it easier and to at least give you the resources to do this yourself if you need to do this yourself. So the first one being a spreadsheet. Like I've said, this is something that you would construct. You would have to think about the things that we spoke about, and we can gladly share a template for you to use. The second one, I haven't used it, but I've heard about it. It's called LifePlan. I believe that it has a 60-day free period. So this is a good idea if you're probably going about your forecast for the first time and you want to start to put this down, but you don't want to have to play with an Excel spreadsheet. Maybe you just don't know how to. The other tool I would recommend, and this is a paid tool, is called Float App. So with Float App, it creates an ongoing forecast. So for example, you can tell Float App that for the next 3 years, we are going to be paying salaries of 40,000 a month or 400,000 a month. And it keeps that, and it creates an ongoing forecast, and you don't have to continually update that line item until the time when that specific expense item changes. And same thing with sales. You can go every month and you can change your sales figures, and you can plan according to what's going on in your business. And the great thing with it is you integrate it with your accounting system. And once that's integrated, it now starts to tell you based on your actuals and what you put in your forecast, how are you meeting your targets, and it helps you to think about it more logically. So while the first two are simple and easy, they don't give you the kind of feedback that will tell you whether your expectations are being met. And given all of this, a very important thing to remember is cash flow forecasting is just the first step. So like we discussed the difference between revenue and cash flow, understand that it doesn't form your overall budget. After doing this, you also need to go and look at your profitability and see if your business is indeed profitable, so that this cash flow is practical and it makes sense, and you're not just shifting money around and playing a game of chess until eventually you don't have any money left. Okay, so I've covered pretty much everything that we wanted to go through. We've spoken about what is cash flow and how do you identify your cash flow problems. What are some of the things that you can do to improve that? I'm also happy to share the PowerPoints as well as the detailed information on what we spoke about today, together with the templates. So again, just drop us a mail and let us know if you want this. So you will get a survey from us tomorrow, which will where you can also fill in your information so that we can create your goal setting template. Okay. All right. I don't know if there are any specific questions that anyone would like us to address. I've been trying to keep track of the chats, but it's a bit difficult to deal with all the chats as well as talking at the same time. All right. Okay. So Ato is asked, private equity deals are mostly about optimizing cash flow and making the business acquired more efficient. Do you have any experience analyzing business cash flows for any PE firms? What are the key things to look at when considering an investment? Are there any books or videos you recommend for someone specifically interested in PE? Okay, Ato, thanks for the question. I can drop you an email and connect you with someone who might be able to assist you. We don't really deal with these kind of transactions. We are more involved in the operational side of things and helping people actually go through their day-to-day and resolve the immediate problems. But I do know a couple of people who specialize in this area that you've asked about. Okay, great. We have 5 minutes to spare. There's another question I'm seeing. Bridget, hi. Sorry, could you retype your question? It's not that clear. Okay, I'm just going to go through and see if there are other questions. And thanks so much, everyone, for joining us and sharing your business profiles with us. We'll definitely check out your pages and share with the rest of our client base if there's anyone that needs any of your services. Okay, thanks, Bridget. So if you need to balance cash flow versus investing in your company, how do you do that? So Bridget, I think the way that I would approach it is I would first approach making sure that you've taken care of the operations of the business before you look at reinvesting, because sometimes you might overextend your business if you take too much money out of your business, or you spend the money on expansion investments. So it is a balancing act, and it's something that depends on what your forward-looking cash flow looks like. Okay, great. Thanks everyone for joining us. Please do drop us an email. Let us know what else you'd like to hear from us. Let us know what other things that you want to understand about the financial statements of your business, about management accounts and what you should be looking at, about any item to do with anything to do with the finance of your business. If you're struggling with forecasting, if you're struggling with pricing, those are the kind of things we want to understand and know more about what you want to do in your business. Hopefully we'll see the same faces at the next webinar. Thanks so much, everyone.